we explore the idea of a wage price spiral and why it is a flawed concept. Hotter than expected inflation has rekindled fears about a wage price spiral, with some arguing that the Fed should tighten even faster. However, as we'll see, this notion runs afoul of basic economics. The wage price spiral is a positive feedback loop where faster wage growth pushes up costs for businesses, which in turn raises output prices. Workers then demand higher wages to keep up with the cost of living. However, this notion is flawed. Higher wages don't cause inflation. They merely reflect inflation that's already happening. To understand why this is the case, we need to look at the market forces that determine wages. As with nearly everything else, the place to start is supply and demand. Businesses' demand for labor depends on productivity, while workers' supply of labor depends on the labor-leisure trade-off. Wages will balance the labor hours demanded with the labor hours supplied. However, wages are a relative price, the price of rented labor, while inflation is about prices in general. These are two very different phenomena. Wages are a matter of price theory, whereas the dollar's purchasing power is a matter of monetary theory. Focusing on the demand side of labor markets shows why the wage price spiral is a bogus idea. Businesses can't afford to pay workers more than the value they add to the production process. Wages are pinned down by productivity, and inflation, which affects prices in general rather than the price of labor, doesn't change this. According to the Atlanta Fed's wage tracker, nominal wages are rising at about 6% per year. This is slightly higher than year-over-year inflation and slightly lower than the annualized version of the most recent monthly rate. Much of the wage growth we're seeing reflects old-fashioned, monetary expansion-induced, demand-side dollar devaluation. While the recent uptick in inflation is worrying, the Fed doesn't need to take a sledgehammer to labor markets to ease the economy's pricing pressures. The Fed needs to get a handle on the situation before higher inflation expectations become entrenched. The best thing they can do for workers is make the dollar's purchasing power as predictable as possible by making inflation small and steady again. To conclude, there is no such thing as a wage price spiral. This notion runs afoul of basic economics, and instead, wages are a matter of price theory, while inflation is a matter of monetary theory. The Fed needs to continue tightening, but they don't need to take a sledgehammer to labor markets. The best thing they can do for workers is to make inflation small and steady again, making the dollar's purchasing power as predictable as possible. Subscribe Libertarian Facts.